Thanks everybody for joining us today. You are here for the Get Legit webinar on basic accounting. I want to take a moment to introduce myself. My name is Maggie Phillipsborn. I am the Director of Membership and Education here at the Nevada County Cannabis Alliance. If you are unfamiliar with the Nevada County Cannabis Alliance, we are a nonprofit trade association representing the cannabis industry here in Nevada County, California. The Alliance advocates for just and equitable local policies and state legislation. We are part of the Origins Council, Regional Council on a statewide advocacy level. We are empowering community success through education and connecting stakeholders with opportunities to participate and collaborate. This Get Legit education series that you are joining us for today, this is an educational series that has been going on for about 4 years now, and its goal is to provide resources to support small cannabis farm operators in cultivating sustainable businesses that are prepared to meet the ever-changing market and regulatory landscape of the California cannabis industry. We have monthly webinars. Please check out our website, www.nccannabisalliance.org. There's a Get Legit tab, and you can see all of our upcoming webinars, as well as links to our past webinars, which I encourage everybody to check out. We have a full YouTube playlist. There are 11 webinars so far. And coming up, we will have monthly webinars starting today, going through April. Please stay tuned online for those and check it out. There are some really great topics that you won't want to miss. After today, our next webinar is Thursday, January 26th, and the topic is Employer and Employee Management 101, and will be presented by attorney Sarah Smale. Today's webinar that you are here for is Basic Accounting 101. I want to encourage all of the participants to utilize the chat feature and the Q&A feature on the webinar. Please ask questions as they come up. We will make our best attempt to get to all of them before the session ends. And I want to give a huge thank you, a few thank yous, one to Nevada County Media for making this possible, for getting us onto these recordings onto a YouTube playlist, as well as some local supporters who are tried and true, Ag Natural and Four Season Garden Supply. Big shout out to them. Our presenter today is Julia Glass, one of my favorite people. And Julia Glass has been a bookkeeper for over 40 years. She specializes in small business and nonprofit support, and she works with QuickBooks and is a certified QuickBooks Online Pro Advisor. Julia is a member of the premier cannabis financial organization, Dope CFO, and has specialized training in accounting practices for the cannabis industry. Julia, we are so grateful to have you here with us today. This is truly invaluable information, and I will hand it off to you.
Great. Thank you, Maggie, for the wonderful introduction. So hello, everybody. It's great to be here with you today. So one of the things, so this meeting today, it says it's about basic accounting, but the main focus is really going to be on reading financial statements. And so that's actually a little bit narrower than even like basic accounting. So I really want to stay focused on that. If you have other questions and we have time at the end of the meeting, we can roll into that. So basically with accounting, and also I want to talk about the fact that, I am a bookkeeper, I'm not an accountant. And one of the distinctions between that is that the main focus of what I do is on recording transactions that will appear in reports that accountants will create and or interpret. So while I understand accounting principles in general, and just from doing it for so long, I understand quite a lot of accounting. I am not a CPA. I'm not a tax expert. I don't have that kind of information. But I do have experience in that just from my own running my own businesses and things like that. So I have knowledge, but I don't have expertise about the higher level accounting topics. I know that I created a set of questions that I wanted Maggie to ask as we were getting started here, just so that I could get a sense of maybe what people needed or where they were coming from in terms of financial statements and accounting, basic bookkeeping or whatever. So I don't know when you want to do that, Maggie. Anytime would work, and I'll just kind of keep talking.
Great. Yeah. So I am going to launch this poll right now. And so if folks who are if attendees could take a few minutes and fill out the poll, and Julia, feel free to keep talking as people do that.
Right. Okay. So a lot of people kind of look at accounting or bookkeeping as this kind of like completely objective thing. It is what it is, and there isn't much change. And while there's a skeleton that on which accounting reports, financial reports are hanging, the actual way that you manifest them is open for a lot of interpretation, and it changes quite a bit based on the industry that you're in, the business organization or entity that you're accounting for. Like some of the questions in the polling question here are about your business entities, because what you do with your books is changes depending on what your business entity is. So there is a kind of universal language about financial statements, and it is seated in the chart of accounts. And in a minute or two, I don't know, I have a screenshot here where we can look at a chart of accounts and discuss the different arenas of that. So the chart of accounts is this basic skeleton or framework upon which your financial statements are organized. And it's a lot of it has to do with vocabulary. There's words about the different sections and the different types of accounts that when you use them, people understand what you mean. There is a trend in the world today of kind of moving away from traditional accounting vocabulary to make bookkeeping more accessible to business owners. So you may hear different things, descriptions about this or ideas about that. But if you are a higher level business, then these are going to be vocabularies and structures that people are going to expect from you to put things together, and the way that you would communicate your financial information to other people. I'm ready to do a screen share. Should we wait till the poll is done, or should I do the screen share now, or?
Feel free to screen share, but it does seem like we have 100% of our participants currently have answered the polls.
Oh, that's awesome.
Yeah, so do you want me to go through the responses?
Yeah, let's do that real quick.
Perfect.
Yeah.
So the first question was, do you currently have bookkeeping records for your business? Thankfully, 100% of respondents said yes. Go team.
Great.
We're on the right track. The second question was, how are you currently documenting your business transactions? There are people who are using spreadsheet programs. There are people who are using desktop accounting softwares. There are people who have the shoebox grocery bag or drawer full of stuff. We've got some folks who use online accounting software, and somebody who is using an outside bookkeeping service. So a little bit of everything, all but the paper ledger option.
Okay, yeah.
The third question was, how often do you review basic financial reports? The majority of people said monthly.
Oh, that's great.
And there was a couple people who responded quarterly, annually, and never.
Okay.
And then, great question, what is your business goal? The two responses were, there was multiple responses for, I want to continue to support myself and my family, as well as people responded that they want to build a successful business. And in terms of business structures, we have a few people who are sole proprietors, and then we have folks who are both single member as well as multi-member LLCs.
Excellent. Okay.
Thanks everybody for participating in our first ever poll.
Oh, right, that's right. Yeah, thanks for doing that, because it helps give me an idea of what, who I'm talking to, So give me a second here to get my screen up. Okay, there we go. So now where's my Zoom screen? There we go. All right, so what I've got here is, again, as we were talking about, that there's this like kind of basic language, a chart of bookkeeping, and the kind of skeleton of this, the framework, is called a chart of accounts. And chart of accounts have a standard that they follow. And if you are following a more conservative or traditional accounting practice, then you would have not only a name of an account, but a number. And no matter whether your business is handling $500 or $500 million, everything, all of these accounts and the way that the account types and the way they're structured are going to be the same in concept. It'll only change in detail. So the chart of accounts has, again, these different types, and they're broken into two categories. And one of them is called balance sheet accounts, and that's they represent one of your financial statements. And then the other section are profit and loss accounts, which represent another financial statement. So, and then we have another kind of basic statement that we call a cash flow statement, which basically explains the relationship between the balance sheet and the profit and loss accounts. A lot of businesses tend to not look at their balance sheet, but it is one of your most important statements to look at and regard, because it in many ways is the true snapshot of your business. And then the profit and loss report explains the changes to the balance sheet. You make money, it goes into a bank account, and so that'll show the balance sheet. You borrow money, that goes shows up as debt, things like that. So so that's one thing that I heard in some training I took that I thought was really helpful, is that the profit and loss statement explains changes in the balance sheet, and that's how they relate. And then if you're using accounting software or higher level kind of accounting things, there's a little category at the bottom where it's called non-posting accounts. And when you're doing certain kinds of bookkeeping, you track things that don't impact either the profit and the loss or the balance sheet. So they go down there. Like a sales estimate would be an example of that. Like, say you're going to bid a job, as a contractor, and you need all this accounting information, but it's not actually a sale yet. So it goes into this non-posting category. So I'm going to look at the top here, and put in blue, we've got our balance sheet account. So we've got assets, and assets are like your bank account. If you are a cash business, it's the cash in your safe. It would be the equipment that you own. There's different types of assets, like there's the bank or cash on hand assets. There's things called other current assets. And we'll look at more details of that because I collapsed this so that it would fit on one screen. So there's some details we'll talk about when we look at the balance sheet directly. And then, and if, traditionally they're numbered with 100 as the prefix code. And then you have liabilities, which would be bills that you owe, payroll taxes, sales tax, just anything that you owe. And then you have your equity accounts, which represent the money that you invest in the business. And like shareholder contributions, or this is if you were a corporation, this is where stock and stuff would be stored. So those are the three categories that would represent your balance sheet accounts. And then below that, we've got the I've got 1, 2, 3, 4, 5 profit and loss accounts. So in the 4 to 400 range, you would put sales. And I put this as one. I'm assuming, and Maggie agreed, that everybody is more than likely a cultivator or supporting a cultivator. So I'm, kind of focusing a little bit on that. So there we've got, I've got sales, flower sales, trim sales, other sales. Then below that is cost of goods sold. And this is expenses directly related to sales. So the most clearest way to explain it is that you are a farm and you buy plants from a nursery that you're going to grow and turn into product. So the purchase of those plants would be a cost of goods sold, like unequivocally. And if you were a dispensary, you would buy flour from a farmer or from someone, and then you would package it and sell it. Then what you paid for that flour is a direct cost of goods sold, unequivocally. So there's other things that can go in here that take more, that are more a gray or require other kinds of support. So they're in the 500 range category for your account numbers. And then there's expense accounts. And this is like everything that you spend money on. Well, not quite, because I'll talk a little bit about this now too. So what you buy something for, how much it costs, depends on whether it's an expense or an asset. Like if you buy a tractor, it would actually be posted up in the balance sheet section under fixed assets. And then, or if you bought land or property, or durable things that are permanent and would be used over time, those would go into the asset column. But if you buy, trimmers or clippers, little kinds of hand tools that are basically replaceable or disposable, those would be direct expenses. And smaller kinds of tools like, I don't know, a blow dryer, a fan or something like that could fall in that category. Between expenses and whether it goes into an asset account is a judgment call that businesses make with their financial advisors. And so those are the things that are directly related to the business that you're conducting. So then you come down and we have other income and other expense that are part of the profit and loss statement, but they would represent income that's not directly related to your business. Most clear example is if you are getting interest from someone's paying you interest for something. Like say you sold a piece of equipment and you're financing it and they're paying you interest. The interest income would get posted under other income because it's not directly related to your business. And other expenses that fall here are expenses that you have that are not business deductible. Like one big example is taxes. Taxes are not business deductions in general. Like if you buy equipment and pay sales tax, then that is a business deduction. But your in general, like your franchise tax board fee for your business entity or income taxes are not legitimate business expenses. So now we've got categories going from 100 down to 900. And this represents the skeleton on which our financial statements are done. So I'd like to ask if anybody has any questions at this point, because if there are any real questions at this point, we better deal with them now, because the rest of it will just be a big giant blob of unknowingness.
Yeah, so I want to encourage participants. You can use either the chat or the Q&A feature on the webinar. I had a question in regards to equity accounts. You said that this is the money you invest in the business. So would this
Right.
be, you know, some people have just started their cannabis businesses, certainly creating the legal formations and so forth in the past 3 to 5 years. Would the would funds that you yourself put in, or say your family member invested, like funds that you initially for the startup or capital expenses, you know, getting that we all spent getting through the permitting process and stuff, would that be included as money that we've invested in the business in that category?
Correct. Yeah, that would be in an equity. Well, it would depend on the structure. So say you had a family member who, if they gave you a loan, you know, then that would actually be a liability. That would be a liability. But if they bought in and gave you money and became have a vested interest in the business, then that would be an equity. That would fall under equity.
Great, thank you.
Yeah.
And then I see Diana has her hand raised.
Is that something I can see, or?
I don't know, but I'll deal with
Okay.
it. So hold
All
on
right.
a second.
Good stuff.
And Diana, go for it.
Julia, this is so good. Oh my gosh, thank you so much for being here with us. So my question is about determining cost of goods, or your one's cost of goods, or cost to produce their product. Can you give us a calculation of how, you know, how to come up with that number based on this sample chart of accounts? Is it as simple as taking the cost of goods line item and just dividing it by, you know, how many pounds one grew? But like, what's the right formulation? Because I don't know if I'm doing it right.
Well, no, that's a great question. And I was one that I expected to get. And it actually is an extremely, for a cultivator, it's not complex in its theory, but no, there is no way to give a simple answer for that. There's a, and I'll come back to that. I'm going to make a note about that. And I was going to talk about it further in the process, but right now I really want to stay focused on the statements themselves, though this is the biggest issue for any business that is handling cannabis, is the fact that only costs of goods sold are able to be expressed as expenses for your business. So how do I get money in there? Like, it's really clear if you're a dispensary, you buy flower, you sell flower, the cost of the coal is exactly what you paid for that flower plus the cost of packaging, period. That's easy. But as a cultivator, they're in a lucky position because they can apply much more of their expenses towards cost of goods sold, but how that gets done in a way that's compliant. And when I use the word compliant, I'm meaning very specifically compliant with general accounting principles. I'm not talking about compliance with agencies or anything like that. So if you hear me say that, that's what I mean. So that's a kind of another thing I wanted to say about the chart of accounts, is that all of this is driven, and how you work with it is driven by a thing that's called generally accepted accounting principles. So you may see this thing that says GAAP accounting or GAAP compliance, and that's all that it means. It's nothing particularly fancy. And basically most of the precepts behind it are common sense. But I will get back to cost of goods sold after we get through the statements. Okay.
Great.
Are there any other questions that we want to look at before we move forward?
That is all I'm seeing for now. So let's just keep going.
Great. Okay, so now I'm going to look at the balance sheet in more detail. So, so this is expanded a little bit more. That would tend to show you what's happening here. So we have assets. So you have your checking account, your cash on hand. If you do PayPal or Venmo, all of these we go in here. Accounts receivable is an asset. That means when you write an invoice for a customer, then it becomes receivable. And so that's an asset that you can actually, if you have that, you can go to a bank and say, look, I have sales orders for $10,000, I need a loan. And you can actually get loans for that kind of thing if you were a different business than cannabis. Undeposited funds is a holding account where, say someone gives you a check, but you haven't put it in the bank yet. So that's where it sits till that's done. Prepaid expenses, that would be, you know, if you paid your electric bill for a year, then it doesn't actually become an expense until you get the bill for the future. That's a little more of an abstract thing and a little higher level than what most people in the arena that we're discussing would need to worry about. And then we get down to inventory asset. And so this is where, so I've broken this down here into 4 categories. And so I have raw materials. And so what that would be specifically in this case would be things like, again, buying plants. You have a plant, you buy a plant. So you would post that into your raw materials category. So I want to keep it really narrow down in this way. Then as a cultivator, there's a thing called work in progress. And so what that means is, like, you have seeds, you have plants, and you plant them in the ground, and you buy soil and you buy nutrients. And so as you're moving them through the growing cycle, that conglomeration of expenses goes into a category called works in progress. So if you value your company, evaluate the value of your asset, then those kinds of expenses would be held in there until they actually become saleable product. And then they move from works in progress to finished goods. And finished goods would specifically be like a pound of flour or packaged eighths or whatever it is that you're doing in your business model. It would be that finished thing. And then under there too, it would be other finished goods that, you know, basically if you have things like that, that are true inventory that would sit there, it would just be, you know, a catch-all to put things that don't fit directly into those other categories. So then deposits, that would be, say you rent a space and you give your landlord a deposit for $5,000. That's an asset to you. It's money that belongs to you, and it's an asset for your company. So that's what specifically is posted there. Then we have leasehold improvements would be, we're in the fixed asset category. So now this is the kind of area where there's a lot of judgments to be made about what goes here. So leasehold improvement would be something like, say you rent a space and you modify it. And to do that, you spent $40,000 putting in some kind of security system. And it's attached to the facility. It actually becomes part of the facility that you're renting. That would be called a leasehold improvement. And so this is, and then we've got furniture and equipment. So if you bought, you know, a tractor, that would go here, or trimming machines, or potentially even drying racks could go here, fencing, depending on where you are, that could also be under leasehold improvements. And a lot of these definitions shift based on how permanent it is, what you use it for specifically. Like, for example, say you rented land and you built a fence there. So if you put up T-bars and put plastic deer fence around, that wouldn't necessarily be a leasehold improvement because it's functionally temporary. But if you put a bunch of concrete and put big poles in and chain link fence that was 12 feet tall and spent a certain amount of money doing that, and it basically is specific to the site, then that would be a leasehold improvement. So there's can be these gray areas in between here. And there's different reasons for posting things as assets. And the way they move, how you expense these things is through a depreciation. So we see down here, that's where the accumulated depreciation comes in. So when you depreciate, usually at the point of the end of your fiscal year, you will post depreciation, and that comes in as a negative number. And then it books down in the expense category as depreciation expense. So that's that. There are other kinds of assets that we can be here. And when I show some of the examples of balance sheets, I'll talk about them. So again, does anybody have any questions about this right now? I think I want to stop after each section and see, because if you are not following it, then it's only going to get worse. So I'm going to start with liability. So if Maggie, you let me know if anybody.
I'm not seeing any questions yet, but
Okay.
I will let you know.
Great. And so let's see, there was one thing I wanted to talk about that I had forgotten earlier. When it comes up under here with the asset and accounts receivable. So under accounting principles, there's two different ways to evaluate your financial statements. One of them is with the accrual method, and the other is with the cash method. So the accrual method is in general considered to be the more business appropriate way to evaluate the financial position of your business. And so what that means is that you would post events when they occur. So that's why there's an accounts receivable account up there, you can see. And then if we go down to liabilities, there's an accounts payable account. So you get so an example of like an accounts payable would be, you get a phone bill, you get it at the beginning of the month, and it's due at the end of the month. So with the accrual method, you would post the date of the bill as when that expense occurred. But if you are using the cash method of looking at your financial statements, you would look at that expense when you actually wrote the check to pay for the bill. So one is like, it's when it happens, when the money changes hand, and then the other way to look at it is when the expense or income is incurred. So if we go up at accounts receivable, so when you write an invoice out to a customer and they have terms, 15, 30 days, 90 days, whatever it would be, the date of your invoice is when you would book that income. And if you were doing the accrual system, if you're following the cash system, when you actually receive the money is when you would book that income. And just in general, the accrual system is considered to be the more, it gives a better picture of the financial flow of your business than the cash method in general. Like there's nothing set in stone with that, but so I wanted to mention that there. So now we're going to go down to the liabilities section, and there's the accounts payable, which would be bills if you book that system. And then you have a thing called other current liability. And these are very specific things. So a current liability would be something like payroll liability. So if you're running payroll, you have an employee and you pay them their wages, and then you take taxes out of their check, and then that sits in your payroll liability account, the withholding that you have, because you owe that. It's not your money. You actually owe it to someone else. You took it from your employee and you're going to pay it to the agency, the state or federal agency that it belongs to. And then again, this would happen with direct deposit liabilities. This is basically a posting account if you use direct deposit, because those things move in and out in their own kind of transaction way. And then tax payable would be, you make a sale, a flower, and then you owe the 0.125 county cultivation tax. So you could post that here and it would keep track of what you owe for your taxes. And those are things like other current liabilities, or a current liability would be very specifically this type of transaction, something that you're holding on to and you're going to give it away really quickly. Then you would go to a long-term liability, which would be something, the kind of measure for that is something that would endure over a year or more. So just a mortgage, a third-party loan, a shareholder loan, anything like that. So that's how those would be posted. And then we get down to our equity accounts. So this particular chart of accounts is set up to show for an LLC because it's referring to shareholders, or actually would be members. This could be, if you're a corporation, you would have stock. If you're an LLC, you have members. And this is where, say you had a group of 4 people come together, everybody threw in $10,000 to do $40,000 to start your business. And so here you would have shareholder contributions of $40,000. And then up here, where it says cash on hand or business checking, that $40,000 would go up there. So, so this is, sorry to jump around a little bit here. So this is one of the kind of general accounting principles that if you're using this, and it's called double entry bookkeeping. And it's also the name of where the balance sheet and all of those comes from. So, so you make a sale, and so the money goes to revenue, and then it goes, the other side is called double entry. So there'll be an entry where the money comes in and then the money goes into your checking account. And so here's an example of a shareholder gives you money and then that money goes into the checking account. And that's the double entry bookkeeping. And so they equal zero. So they net each other out. So that's what that's about. And just also in general, for any balance sheet or profit and loss statement, there should never be a negative number on your financial statement. And that's because these accounts, except for in totals and things like that, the only exception would be accumulated depreciation, which is always negative because you're taking money out of your fixed assets and moving it to the expense account. But if you're looking at your financial statement, you're looking at your balance sheet and you see a negative number, then that should throw a little flag up for you. Why is that number negative? It shouldn't be. So it isn't necessarily a problem, but it's something that if you're looking at your statement, you're going to want to go ask that question and find out why. And because it could mean that something is not posted correctly or something's not working right. Retained earnings is a special holding account with equity where you move. Retained earnings is something that happens automatically, and the way, to me, it's very kind of abstract, but it's so what you do is at the beginning of the year of a fiscal year, you move the prior year's loss or income into retained earnings so that when you go to look at your balance sheet for the next year, you're looking at just that year's activity. So the retained earnings is the profit or loss, or profit and loss, because it's a combination of numbers from prior fiscal periods. And it's a little abstract. It's a little more abstract. It actually is just an equation, but it's often something that people don't reconcile. And down here too, under the equity account, I have opening balance equity here. If your books are done correctly, the opening balance equity account at the end of your financial period, your fiscal period, should always be zero. So opening balance, would either go to one of these other accounts, or it would be a part of a shareholder. It should be assigned to another equity account. So it's kind of a holding account that you use to hold things while they're in transition, but then it should functionally always be zero. It should be assigned to someone's contribution or moved to the expense or income that it may represent. Okay, so those are a quick view there of the balance sheet accounts that are part of this larger chart of accounts. So we've got the chart of accounts and it breaks down into balance sheet accounts and profit and loss accounts. So now I'm going to go to look at the profit and loss accounts. And if anybody has any questions, especially when we hit a section here, again, it's much better to ask them about this specifically, because otherwise other stuff won't, you know, it just will stay muddy. Okay, so there we've got revenue. We kind of already covered that. And then we've got the cost of goods sold. And so this is expanded a little bit here. I've got cost of goods sold, direct labor, other COGs, product for resale. So what happens here with cost of goods sold is that, so I'm going to go back here. So we go to the balance sheet account. So when I sell my finished goods, my flour, you know, say I sell it for $1,000 and it cost me $700 to make that pound of flour. So when I sell that pound of flour, that $700 gets moved from finished goods to cost of goods sold. So that's how that works with inventory. You have inventory. It's an asset until you sell it. And then when you sell it, it becomes a cost of goods sold. So that's how that works. And this would also be true of packaging. Say you would buy packaging, you literally would probably have an inventory asset that says packaging, depending on how much you have. And then when you sell packaging at the end, then what you actually used would come here under cost of goods sold. And this is why businesses take inventory at the end of the year. It's so that you can tell how much you spent on how much you spent on the inventory that you sold, so that you can make these corrections and adjustments in your financial statements. So then I have other things here which may or may not be considered cost of goods sold, like storage and warehousing, testing. In my opinion, those could be expressed as COGs for a cultivator. Arguments could be made for that, but they're more abstract. This kind of goes back to Diana's question about how do we know what to do with that for a cultivation. So we have the money that comes in, we've got cost of goods sold, and then we have expenses. And this comes down so you see here, I have two different things. One of them here is direct labor, and then down here I have wages indirect. So like if you are working, you know, on the farm to growing flour, then that would be direct labor that could be related to your cost of goods sold number. And then if the time that you spend working in the office, or if you have someone who just does your metric compliance or county compliance, then those would be indirect wages that would not be considered direct labor towards the production of your product. And so those are things to be looked at. Then we've got, you know, just this is standard stuff. This is not organized particularly well, but I just wanted to kind of show you how some of these things work. Rent, telephone, going through. And then here we've got subcategories, which would consolidate different sections of your financial statements. And these, I think, are pretty clear to people, you know, what they may mean, just direct expenses. It's pretty clear.
I've got a question or two here for
Good.
you while we're in here.
Okay.
One is any packaging that wasn't used, say in the year, does that stay in assets since it wasn't used for, say, like finished sold product?
Technically, yes.
Great. This is such great information. What sticks out to me, honestly, was and pardon me for going back a step in your slides, but the accrual versus cash systems,
Right.
and making sure that I'm being consistent throughout everything, that if you mark one invoice like the day with the invoice date, then keep with that system, as opposed to then all of a sudden I've put something in when it was actually paid, and like continuity, I guess, with however you're choosing to input that information.
Right. And where this becomes important is when you file your tax return for your business, they're going to ask you, what method of accounting are you using? Are you using cash or accrual? And you can't change that easily. You can't go, oh, I'm going to do cash accounting in 2022, and I'm going to do accrual accounting in 2023. You can't do that. They will, it will trigger problems for you. There are documents that you can file asking to change your method of accounting with federal and state agencies, but it's considered onerous by accounting professionals. It's like, kind of a joke. Oh my God, the dreaded whatever the form number is. So it's like a technical thing.
Important to be consistent.
Yes, yeah. Well, yes, to be compliant with accounting principles, it has to be consistent. Yeah.
Great. Well,
Now I have a client that they look at both cash and accrual reports, because it gives different pictures of your business. So, this is a client, she runs a property owners association, and she's an accountant. So she pulls these reports and they like sing to her the difference between the cash and the accrual. It shows her things that are useful to her.
Interesting. But we have another question about the screen we're on here.
Okay.
Just further clarifying the direct labor versus wages indirect.
Correct.
So
okay.
is direct labor just it has to be sort of on farm labor in cultivating the plants that are producing the final product, and everything outside of that is wages indirect?
It would be, no, I would say it could be painted more broadly. So now we're entering into this area that I kind of alluded to earlier, which is that, people seem to think that these things are like, it's like an objective fact, but it really isn't. It's basically what you decide within reason based on generally accepted accounting principles. So different businesses will make different choices about where that line is drawn for different reasons. Like, I'm not trying to be evasive, but it is subjective. So the criteria for that kind of decision would be based on one's willingness or ability to support it under audit. So if one gets audited, people they're gonna look at those conversions. So you have to have a good reason why you just said, well, I'm calling this cost of goods sold. You have to have a good reason for it. Like a clear line would be you're out planting plants, you've got plants in the ground, that's clearly there. But then you go over here, well, trimming, is that cost of goods sold? Well, definitely, I would say that. But then you've got packaging, is packaging cost of goods sold? So then you start hitting these like little gray areas. And what as a business person you have to do is you need to make a decision about what you're going to defend under audit. Because that everybody will have different tolerances for risk and what they're willing to do there. Did that make sense, what I just said?
I think that was a perfect response. Thank you.
Okay,
And that is all the questions for the moment.
great. Right, so this is an important distinction, like you as business owners, like who you have helping you and giving you advice. There isn't a whole lot of certainty in a whole lot of accounting. And the more certain people are, the more concerned I would be about their input. You know, if they're not showing you both sides, what's the risk, what's the reward, what's my exposure? Because as a business owner, it's all about risk management, you know, like not only necessarily compliance with accounting principles, but, you know, like I'm not gonna worry about deer in my garden because, you know, I've never had deer damage. Other people will, you know, put a fortress around that. So everyone has their own tolerance and views about what's risky. And so that goes with your bookkeeping and stuff too. And there's two sides to all of those things. There's usually an array of responses, all of which are appropriate. And going back with auditing, what I'm hearing from the organization I belong to, in general, the IRS, if people come under audit, they are being kind to people who are making an effort. So if you're like keeping good books and you're doing stuff with intention, like, and they don't really agree with that, they won't necessarily, that's what I'm hearing in the wind, that people who are getting audited, if you're doing a reasonable job, then they're working with you as opposed to being punitive. So, so there we've got the profit and loss accounts. And so these are all part, again, of the chart of accounts, this giant framework that gets broken down into the balance sheet accounts and the P&L accounts. So now I want to let's look at a balance sheet. I have a couple of different examples of balance sheets. Maybe I'll do this one first. I'm going to show you this one first. So I don't know, I got this off the internet. It's just a fake business. It's just an example. And so the thing I like about this particular example is that it kind of shows you why it's a balance sheet. Is that over here, you've got your assets and the total assets. And then over here, you have your liabilities and equity, and they're the same number. And that's why it's called a balance sheet. And if you look at this, see, there's no negative numbers here. They're all positive. And the reason for that is that, you know, the accounts on the left side are by nature negatives, and the ones on the right side are by nature positives, and the one on the left side are by nature negatives. So when you add them together, they're the same. They cancel each other out. So here we go through. This is this also shows an example of a balance sheet, or these financial statement reports in their essence should never be more than a page. That's kind of a goal to strive for. So if you have a balance sheet that's 5 pages long, your chart of accounts is too complex. And there's ways to simplify it. But again, when we're looking at financial statements, you want them to be broad strokes. It would be in your bookkeeping and with other reports that you would get more finely cut information. Oh my gosh, I only have 5 minutes left. Really been blabbing here. I'll try to speed up. Okay, so here we go. Here's your current assets, cash, petty cash, accounts receivable, and then investments. So that would be, if you own stocks or something, that would be part of your asset list. Here we've got land improvements, buildings, and then here's the minus. That's what those parentheses mean, is minus. And that's your depreciation, your accumulated depreciation. And then the net value. And then I wanted to kind of go down here and show people this intangible assets. And you would see these more like if you purchased a business, then you would be pulling in, you would be inheriting like, say, a customer base or a brand name, and there's ways to assign values to that. And like, again, like a trade name, like say someone has a line of flour that they've copyrighted, they have a name, they have a following, then that can be evaluated and that comes in as an asset. I can't see what's underneath. I've got my Zoom bar here. There's something, and so all those things total 770. And then here's our liabilities. So this would be notes payable, accounts payable, wages payable, interest payable. Again, breaking all of these down, long-term liabilities, the total liabilities of 481. And then there is whatever this number is here for the stockholders' equity, and it equals 770. So that's a balance sheet. And then I'm going to show you another balance sheet real quick here. And this is one thing that's called collapse. So this is one way that you can simplify your balance sheet here, is to just have it down with the entries that are meaningful. Like this is just the headers. So we've got a 6-line balance sheet. I have how much money I have in the bank, your current assets. I know what I own in equipment and materials, fixed assets. I know what I owe immediately, current liabilities and long-term liabilities, and then your equity. And so then again, you see that the total assets equal the total liability and equity, and there's no minus signs here. So this was what that balance sheet looked like before I collapsed it. So it's a little bit broader here. So now we can see what exactly I have in each account. I can see that my other current assets is undeposited funds and inventory assets. And then I see the actual fixed asset, which is my truck. So there's that. So then we go over here to a profit and loss statement. So this is actually a statement from a sample company in QuickBooks Online. So this is a standard QuickBooks Online report. So here we've got income, again, design income. This is a landscaping business. Here's an example of where a negative would come in, is if you're posting discounts under income. Then we go down, we've got his cost of goods sold is simple. It's probably just materials that he bought for, rocks and gravel and things like that. Then expenses, kind of simply done here. And then other expenses are, who knows what those are. Those would be reports that you would, you would pull reports for that detail. And then here's an example again of this same profit and loss statement. Did I do it? Where, oh, maybe I've got it wrong. Okay. No, okay. I thought I had it collapsed, but it must not have printed correctly. So one thing that can be done here is you can collapse them so that you just have the headers, and then you just get like a single page and things like that. So now I'm going to go real quick to, is everybody okay with going a little bit longer? Because I actually am out of time. I didn't even think about timing myself on.
Sorry. We're here with you, and so
Okay.
take as much time as you'd like.
Okay. So, where is my statement of cash flow? I need to. I'll look at this other one. Okay. So here is, again, this is a statement of cash flow from, okay, so the reason that cash flow is important is because, like, so if we go here, we go back here, what happens is if you have a loan, I'm going to go back here. So we've got a loan, and that's on your balance sheet. So if I make a loan payment, or I have a mortgage payment, I'm going to spend, $1,000, $2,000 a month making that payment. but that isn't an expense. That's an interaction with an asset account. So, or, you make a payment on a piece of equipment. So that's money that's coming out of your bank account. But when you look at your profits and loss statement, it's not going to show up there at all. So what the statement of cash flows does is it evaluates the relationship between your investment accounts and the money that's coming in and out. So we start here, and this is the operating activities. We'll see it's broken into 3 different categories: operating activities, investing activities, financing activities, and then it tells you how much money you have at the end left between those 2 transactions. So we've got your net income, and you've got your accounts receivable, inventory assets, accounts payable, then MasterCards. What you do is you list here these adjustments to your incoming cash. And this is done automatically by a software program. You can get templates for doing this for yourself. From your financial records, you can create a cash flow statement yourself. But I always just, pull a report from a software program. And then we've got net cash provided by operating activities. So we've got that. So you've got a net cash of $1896.02. Then you have your investing activity. So you bought a truck, so that's coming out. And then you've got financing activities. So these come out then, and then you've got the net cash by financing activities, net cash by investing, net cash by operating, and then you tally those up and you end up with your cash for the period. And
Got a question for you.
yeah.
So, and this came up, I believe, with the line item in that screen share for MasterCard, assuming that could just be credit card expenses. Is that?
I believe that it would be payments.
Okay, so your credit card payments. And I guess, and there are no stupid questions here, so please ask everybody. My question about that is that, so would you?
No, this would probably be the balance of your credit card. The balance on your credit card, whatever it might be.
Remaining. So if you're inputting, say, what your credit card balance is throughout this process, though, am I just saying what I'm paying on my credit card, or am I teasing out what the expenses in my credit card statement were to?
No, these are like broad. This is a very broad thing. So, and you see here, it's covering the period from January 1st to December 21st. It's over a year. So you would maybe pull this once a month and it would show you, I had this much income, and then I had this financing, this went to my mortgage, this went to my truck payment, and I bought a blankety blank, and, so you would get that, I bought a trimmer, so that's going to go in there. And at the end, because I bought a big thing, it's going to be negative instead of positive, because say you bought something and it's not offset by other things. Like, so here we've got a notes payable, which is offsetting the cost of this truck. So they've lent somebody $25,000. So that's why they're not showing a negative cash flow there after buying the vehicle. Does that make sense?
I think so. Thank you.
Yeah, I'm not as strong with the cash flow as with the other reports, just in terms of trying to explain them. Like when I look at them, they make sense to me, but I'm not as good at explaining them. So that is pretty much what I have here. Thought I had another cash flow statement. It was from a zero account, but I don't want to pull that I don't want to try to get that now. I'd have to go through a whole thing.
This
to
was
pull.
a tremendous presentation. This is like really invaluable information, Julia. I personally wish I had learned some of this years ago in my life.
So just kind of to toss another thing in kind of real quickly is that like I would not expect to, if you're not used to looking at financial statements or understanding them, the best thing that you can do is just look at them. Like, even if you hate it, like most people, you show them a financial statement and their eyes glaze over and they drool or they go to sleep or they leave the room. So that's like totally normal to like look at that and not have any idea what's up. But it's really important to look at them, even if you don't understand them, because the only way you'll understand them is by looking at them. And give yourself quite a bit of time. If it's all gobbledygook, it doesn't make any sense, you know, give yourself 6 months to kind of feel a sense of progress and have someone sit with you and go through it. And over time, I was telling Maggie a story about a friend of mine who's an artist, and just recently I've been doing her books for like 10, 15 years, and she's just recently interested in her financial statements. And it's been 6 months of sitting once a month with her going through things, and she looked up at me and she goes, I'm getting it, you know. So give yourself some time, be kind, and just look at them, even if you don't understand them. It's important.
Such great advice. Thank you so much. I want to give everybody on the webinar a chance. If there are any questions, please feel free to participate in the conversation. And just know that this is recorded and will be available online to come back and reference. There's such good information here.
Right. And the one thing we didn't touch on, which had been requested, and I'm sorry that I kind of lost track of time there, but is the idea of there's many things about your books that won't come from financial statements. There are things that are called key performance indicators, such as the amount per square foot of your garden, yield, things like that. And these are things that are tabulated separately with the use of spreadsheets and other kinds of calculating devices. And then you know, I could talk another hour actually about stuff, so I won't even start. But you know, about thinking about, do you make money or not? Because you can be generating tons of revenue and losing money. And you don't know that unless you pull your statements and you look at them. So.
Well, that sounds like it would be a perfect part 2 webinar for another day. But thank you so much for taking the time with us today. Thank you to everybody on the webinar for participating in today's Get Legit session. As I said, Julie Glass is a resident here in Nevada County, who I don't know if you want to offer your services, but
I actually am, my practice is pretty booked, but if anybody has any specific questions that they would like, you know, to talk with me on the phone for half an hour or whatever, feel free to send me an email. That's the best way to connect with me. And then I can send you a link to my calendar. And I'm really happy. Would really be happy to sit with any of you and go through statements or do consultations, you know, like a half hour or whatever. I would be happy to support the community in that way. And, you know, and if you do have specific accounting needs or bookkeeping needs, I can talk with you about that, and maybe provide solutions that are me or not me, you know, that could be helpful.
That's wonderful. Thank you so much. Well,
yeah, thank you guys so much for being there. And
yeah, and I want to encourage everybody to check out the recordings, www.nccannabisalliance.org. There's a Get Legit tab at the top of the page. Our next webinar, which is on employer and employee management, legal perspectives and more, very important compliance information, is January 26th. And with that, I want to just say, have a wonderful evening, everybody, and I will see you in 2023.
really, right.
Thanks so much, and have a great night, everybody.